Hello, this is Mark. We are going now into part 4 of option strategies. This time we are looking into butterflies and jade lizards strategies. Again, enjoy it. Well, what is a long butterfly? Long put or long call butterfly? Let's say the put side is nothing else that you're gonna sell two puts at the money. Selling two puts right away where the stock is. In this example, you can see US steel was 23.93, and we are selling two puts at the money, the 24. And as a protection, we're gonna buy at 24.5, and we're gonna buy at 23.5. So in other words, the maximum profit would be 44 because actually we bought or we have to pay for this kind of strategy 6 points or $6, so that we see that the range is $50 or 0.5. So it's always that our maximum profit is 44. But you understand these numbers look very nice, but you have to realize that you only get this 44 maximum profit if the stock would really close at 24. So this is maybe interesting if you do a strategy of 1 or 2 days, but seeing, let's say, this example that we have another 2 weeks, there are so many things who can happen in 2 weeks that you would probably not do this long put butterfly, because you understand this can move to 23.5, can move to 22 or whatever. But I just show you what actually are the meaning of this kind of long put or long call butterfly. So here the long call butterfly of US steel is a bit different shown, because the strike size have been a bit extended in a way that I would sell two calls at the money, 24, by 125 and 123. So it's always there's a full point in between, which is $100. So your maximum profit would be 75. Your loss 25. This is what actually you have paid for. And here's maybe interesting because I have extended the strikes. You still can do that. I mean, you can do selling of the at the money, and maybe you could extend the buying call to maybe higher and lower strikes. But as I said, I think it's interesting only if the stock would really sell or would be traded on the April 28, which actually I did that for the earnings. Around that price you have sold the share, the options. So I think it must be always around 24. And as we said in earnings, stocks can move up and down 10%. So this strategy, I'm not so sure if it would work, because it's obvious that if whatever you sell at the money is an option which you sold the day before the earnings. So the next day, the stock can open completely in a different level. So your option would be worth, or let's say your option would have a much higher value, is because that you have fixed something at 24, and let's say the stock would open at 25 or 27 whatsoever. I just did an example on a long put butterfly on Tesla. I think it's quite nice that you can see that in a graphic form, because usually it's in a table form, and here you would see how it looks like. That means here you're going to sell at the money, and here you're going to buy as a protection, and here you can see the stock. So in other words, you can see now we're going to sell at 155, we buy 152.5, we buy 170, 57.5, and then always at the end we have a kind of debit of 12, so it's almost flat. But again, it would be interesting or only worth if the stock of Tesla would finish in about 2 weeks at 155. Well, Tesla anyway is something really interesting to trade, especially I think is really appreciated by option traders, because you have really movements in Tesla in a way that the stock was at 200 not long time ago, and now it's around 150, 160. So there are many strategies offering to Tesla, but I would always work with some protection like a call spread or put spread, or whatever, because it's really this fluctuation is almost impossible to control. Now, coming to Jade Lizard, I have to admit this is something very interesting, and it's not that long time that I have used this strategy, and I like it very much. A Jade Lizard is nothing else that you have again a combination of a call credit spread plus one put. So let's say you are looking into a stock which actually you believe that it's a bit sideways, but you want to be protected on the upside. Because you understand the thing is always with a kind of stock like Google or whatever is whenever they get a recommendation, suddenly they are really gone to 110 or 120 dollars. But on the other hand, when you know that you have sold a 106 call and buy a 107 call, you know that here your risk is just on the upside by 1 point, or let's say 100. And what you do is just to get a bit more income, let's say, is that you sell a put option at 100, which is, you see, a bit out of the money, in order that you can get almost $150 for this 2 weeks strategy. We can say again that your maximum profit is what you receive as a premium. Your risk is only on the downside, not on the upside. On the downside is that you may receive this 100 Google, or you have to take this 100 Google when it's below 100 because you sold a put. But I would say that this is something maybe you consider that you would say in the worst case you would take it, or as I said, always you could roll over the put after that into a next month, not using any more the Jade Lizard, you just simply roll over the put. So as I said, I think this is a very nice strategy, which I would recommend for doing even on earning sites, because it's always that this is something which really makes sense to play on both sides. So you may do the same thing on the other side. I mean, as a kind of reverse Jade Lizard is nothing else that you go on the put side. That means you sell a 110 call, you buy 103 put, you sell a 104 put. So it's a put credit spread including a call. So this time you would be protected on the downside, but not on the upside. So as I said, I mean, if Google goes over 110 and you don't have the shares, okay, you need to really buy and deliver the shares at 110. But on the downside, if you believe that the stock really could go down or there's a danger to go down, you are protected. Your maximum loss is just 100. So this is the other side, which probably could be working too. Just is interesting that people tend more to protect on the upside in a way that they don't want that the stock would run away, and they would have to really buy in to cover the call option. But selling a put option, saying, okay, on the worst case, I would buy the stock, is an interesting aspect, because as I said here again, if you would have sold a call at 110 and then let's say the stock is near 110, you still can do a rollover to the next month of 110. So it would work out to do rollovers on and on, in order not really to think, oh, maybe I get executed. So I think in general a J lizard is a really interesting thing, and I would really recommend you to make maybe some tests, especially maybe in stocks who are moving sidewards or maybe are not this high volatility. You can see on a Google has a volatility of 33%. So this is nice to do a J lizard, I would say. Well, now all strategies part 4 has been explained. You can see now the case study of US Steel. So more case studies will follow. My aim is just to give you a basic understanding of the strategies, option strategies they are offering in the market, as well as Tasty Trade is giving you that opportunity to choose one of them. And I think once you know more or less these most common ones, I think you really can go into the market testing out and looking what probably is the most suitable for you. I hope you have enjoyed those videos, and whenever you have any question or suggestions, just feel free to contact me by mail. So far, so good. I wish you a nice day. Bye bye.